An exchange can afford significant tax advantages to property owners. One may sell a qualified property and reinvest proceeds into a replacement property. To put it simply, at time of sale, which includes foreclosures, short sales and deeds in lieu, real property is taxable in the year in which you sell the property, but a 1031 exchange delays the taxable event. In theory, one could exchange into numerous investment properties over the years and pass those investments on to their children at the time of their passing. At that time, their children could realize a step up in the cost basis of all of those investments to current fair market value, essentially eliminating the tax burden altogether. Some examples of qualifying like-kind property are fee simple interest in real estate for a 30-year leasehold or a tenant-in-common interest in real estate. Residential, commercial, industrial or retail rental properties for any other real estate. Raw land or farmland for improved real estate. Oil and gas royalties for a ranch. Rental ski condo for a 3-unit apartment building. Mitigation credits for restoring wetlands for other mitigation credits. I think this should help make it clear. Examples of non-qualifying like-kind property are stock in trade or other property held primarily for sale, i.e., flipper property. Foreign real property for U.S. real property. Stocks, bonds, or notes. Certificates of trust, securities or other evidences of indebtedness or interest, or interests in a partnership. Warning: this information is not intended to constitute legal, financial, or tax advice. If you are considering doing a 1031 exchange, you will want to reach out to a 1031 exchange intermediary.